All right, almost time to wrap up 2024. Welcome back to another real estate market update for the Greater Milwaukee Area, this time December 2024. I can't believe it. This is already the 5th December market update that I'm making for my YouTube channel. I'm always getting a little bit emotional. Of course, it's December. So a lot of stuff has happened this year with our clients. There are so many stories there with our team and with the market, of course. So that's the spirit for today. I want to keep it a little bit high level and look back on what happened this year and what can we expect. How are we entering 2025? Because this time of the year, it's kind of the big annual reset for the real estate market. Almost like winter, it's the same thing. You can really count in Wisconsin that winter is going to happen. And the same thing is with the real estate market. It's a very repeating pattern that we see every year. So we'll take a look at that today. And then I have some economic data for you. We're taking a look at what's happening with the job market, really high level, and in terms of how does that impact the real estate market. What can we expect from the Federal Reserve and from rates, from mortgage rates, and from inflation, and then I'm going to wrap it up with a little bit of a very, very high level expectation, what I think may happen in 2025. Of course, super speculative, and this is the future, so nobody knows what's going to happen, but I'll give it my best shot, and so at least you know what my expectation is for next year. All right, as always, let's get started with the latest numbers from MLS. Inventory is always my first number to take a look at because that really tells you where supply and demand are meeting, and inventory is the result of this. So no surprise here, inventory up again 25%. This has been a very stable trend for the last 5 or 6 months or so. This is of course great from a buyer point of view because the last years we've been around a little over 2,000 units. So this feels like there's almost twice as much inventory out there right now, which is a huge improvement. But at the same time, it is still relatively low inventory. When you look back, I have historic numbers below. So we are still far, far away from what we used to see in the market, but much better than what we had. With that, the market remains very, very tight. Only 1,768 transactions closed. This is a very small volume for our market. We have seen a lot of part-time agents quit this year because it just wasn't worth it for them anymore. And that's just in the nature of the market. Velocity-wise, this is normal for the season. We're seeing the market slow down. Of course, we're entering holiday season here, so 11 days on market. And on the pricing, $330,000 is now the median home price, and that is up 10.2% over last year in November. December numbers will not have a big impact anymore, so I think overall appreciation for the year, in a few weeks we'll have final numbers, will settle around 7.5–8% for the year. But I'll keep you updated with the numbers when I have it. And then worth mentioning, if you look at historic numbers below, you can see that in the last 9 years, real estate values have basically doubled in the Milwaukee area. And I have some more details for you here a little bit later. What have we seen in the market in the last few weeks? Well, the election slowdown is over. We have seen really an uptick in activity, which we kind of don't expect in November, but it happened. And that's relatively normal because leading up to an election, everybody kind of freezes because there's that uncertainty. That's true for businesses just as well as for families. And once the election was over, we have seen really an uptick in activity online, with phone calls, with emails. It literally happened right after the election, and it shows in the data. That is the interesting part. So good thing that we have the election on the books and we have a decisive outcome. We know what happened. We have certainty now, and now we can move on. In terms of inventory, with those inventory numbers, good deals can be negotiated this time of the year. Typically, end of the year is always the best time to negotiate, especially if you're a real estate investor. I have 2 deals under contract that hopefully I'll be closing this week. And historically, it's always a good time to negotiate. What's the downside? The downside is a lot of that inventory that you have out there right now is pretty picked over. So the good stuff, for the most part, is already gone. So it's condition or price too high. But this is also the time of the year where you can negotiate typically the most. December and January are off season in the real estate market. So we're getting into that phase. Everybody's on holiday mode right now, looking forward to the next few weeks. And the interesting part is, and this happens every year like clockwork, it's almost ironic to me at this point. So buyers and sellers are right now on the same page, so to speak, because on both sides we see activity coming down. There's fewer houses coming on the market. There's fewer interest from buyers, so the market is kind of doing this and getting into winter mode here. But then the interesting thing happens right on January 1st. A lot of buyers that have not been in the market jump into action. I think that has to do with they've been talking with family that next year they're going to buy a house. January 1st, they wake up. It's 2025, so it's time to go on the internet and look for houses. And the irony is there is not a whole lot of there because a lot of listings have expired literally on New Year's Eve. And there's not a whole lot of inventory out there. And sellers are not really in a hurry to come with inventory. So they need much longer. They're planning, they're preparing. Maybe they're procrastinating a little bit. Traditional wisdom is to bring your house on the market in spring. There's some angles to that from a seller point of view on how you can play this to your advantage and not do what everybody else is doing. But basically, we see this pattern every year. And what's happening is the buyers are starting. There's no inventory out there. And so everybody is looking at that one house that is listed this weekend in Wauwatosa. And then and one person gets it and the other 25 didn't. And, that builds up the anxiety that we typically see in the spring market. So how do I know this? From experience, it happens literally every year. Speaking of experience, if you are thinking about moving next year in 2025, bring me on board rather sooner than later, because the earlier I get involved, the more you can pick my brain, the more questions I can answer, the more I can help you with strategy. We are standing to close this year 105 transactions. If everything goes well, we have a few more before Christmas to get our clients into their new house before Christmas. And the reason I'm telling you this is because we are gaining a lot of experience. We have a lot of data points. We're involved in a lot of deals. What's happening between me and the team, so we're 5 people in total, we have probably seen over 1,000 homes this year in person in Milwaukee. We have probably written well over 300 offers and been involved in negotiations. We have done hundreds of home inspections. We have done a lot of listings. So from all of that, that leaves a big pool of experience where you know what works, what didn't work. And that is, my brain, and it's here for you to pick. I ran into a home buyer yesterday, actually, at an open house. I was there with clients, and he recognized me from YouTube, and he made it a point to come up to me and say hi. And I think he was under the impression that I'm the guy on the internet and I'm not available, but you can actually give me a call. Don't be surprised if I pick up the phone. My number is right here. That's my cell phone number. You can text me, you can call me, and I will actually pick up. If I'm in a meeting and you don't get me right away, I'll promise I'll get back to you quickly. Most people prefer to send me actually an email, or you can go on my website. There is a schedule a call button up there. And then you have access to my calendar and you can see what I'm doing on the 16th and what times are open, and you just pick one that works for you. That's all on that. Let's get back to the data. Inventory is rising to a new high. So, I've kind of alluded to that already. The blue line here is total inventory that we're seeing on the market. And as you can see, this is a super stable trend. The red line is the new inventory that's coming on the market. So this is dropping off. If the difference is confusing, let's say we're looking at the Mequon market. So this is where I live. We have currently 44 listings on the market. So this would be the blue line, and only 2 new listings came on the market in December. So that's what's coming here. The data is not there for December, but we'll see that relatively soon. So that means out of the 44 listings that we have on the market in Mequon, a good portion of them are already under contract and they stand to close. And the rest of them, well, for some of them, there is a reason why they haven't sold. So it could be the price or could be condition. But we're seeing inventory going up. And that is a very, very welcome trend because we have been absolutely inventory deprived over the last few years. So that's good that we're seeing this. In terms of what will happen next year in spring, from everything that I can tell you right now, we are going to see a repeat of what we have seen this year in spring. So the pattern will kind of look similar. There's not going to be a whole lot of new listings here in January and February. Meanwhile, the old inventory is going to clear out. Some sellers will be motivated enough to negotiate at that point. And then we have the spring market starting usually in March, April, and May. So this is when most of the new inventory is coming on the market. And then overall inventory should go up, hopefully even a little bit more. But the other thing that's going up in spring also is competition. So if you're not familiar with this chart, this is a sale to list price ratio. So this is telling you how much people were negotiating deals, how much over asking price or below asking price they were telling. Historically, 5-10 years ago, this used to be around 95%. So on average, people expected to negotiate 5% down from the list price. This is not happening anymore since the COVID years. It goes the other way around. So in summer, we're usually seeing 102, and the last few years we have seen even 103% average sold to list price ratio. So on average, people were paying 2%, 3% over list price. In a lot of examples, that meant in the hot markets, Whitefish Bay, Wauwatosa, West Allis, etc. Bayview, of course, we have seen 5%, 10% over list price. And we're still seeing that occasionally, even now, though this has dropped down to 100%. So on average, as a buyer, you have to manage your expectations. Even now, you are on average not able to negotiate much of a discount. Of course, when you look at individual deals, there are some where you can negotiate. And here you can see the election effect. Look at what happened here in October, and we came right back up here. In terms of what to expect for next year in spring, kind of a similar curve like here. And keep in mind that this is lagging by 30 days. So most of the deals that get put under contract, let's say in February, they will show up here in this statistic a month later in March. So there's a little bit of a lag here. In terms of sales prices, this is super important, and I'm showing you here a 1-year pattern, and a little later I will show you I think it's a 10 or a 15-year pattern, but this is just the last 12 months of what has happened to median sold prices in Milwaukee. Now, we started out here at about 280, 290, and we peaked here at 350 in July, and now we're coming down a little bit again. This doesn't mean that your home is swings in price by $50,000, $60,000 every year. So this number is a little bit skewed because you have more of the nicer homes selling in spring than in winter. But it is still true that there is a difference in fair market value of a home depending on what time of the year it is being put on the market. So there's a little bit of strategy involved. How do you play this best, especially if you're buying and selling at the same time? How do you do this? Do you buy first? Do you sell first? That's usually where I can help when we sit down and say, okay, what's your personal situation? What's your financial picture? What are your goals and your objectives? What's your risk tolerance? And then we try to make a strategy out of all that kind of plays with the market and not against the market. So in terms of what's going to happen next year, you can see that we're ending the year quite a bit higher than we started it. So this will probably drop down a little bit more, but safe to assume that we're going to start the spring market at a higher level in 2025 as we did this in 2024. So when you look here, the big picture, and you zoom out, home prices over the last 5 years have increased quite a bit. Nationally, average 57% here. Wisconsin was one of the faster appreciating markets. But take this with a grain of salt because it's the magic of small numbers, right? It's a lot easier from a $200,000 market to increase 50% than from a market that's already a lot higher. So we call it the magic of small numbers. But nonetheless, this is really, this has boosted homeowners' equity a lot. And a lot of people are sitting on a lot more equity that when they're selling the house now and buying a new one, they're coming with a huge down payment, which is, of course, helping with affordability. Which, by the way, I should probably make another video about affordability. And let me just quickly interject this here. I would love to hear from you what you would like me to talk about. Put some comments down below. What is the stuff that you like, you want me to do more about? And what is the stuff that you're not that interested in? So I want to have your feedback so I can customize the channel a little bit to what you're looking for. All right, let's take a look at the big picture here in terms of what's happening with home values compared to the rest of the US. So in green, you have here the Milwaukee metro market, and in red, you have the national market. If you understand this chart, I promise you, you understand more than a fair amount of real estate agents out there. And you have the context to really navigate this. So when you look at the national average, this is US average, you can see here that during the COVID years, the market really went nuts on a national average, and home prices, after relatively stable development, the market really exploded and prices went up there. So now then we've seen some consolidation last year, and this year was a little bit of an increase. So that's what's currently happening. Milwaukee, on the other hand, didn't go nuts here in 21 and 22. We kept it true to the Midwest spirit. We kept it very even-keeled and very conservative. So this didn't happen. A very stable development. We just continued on our normal path here. The last few years have been, you can see that the amplitude has gotten a little bit stronger. This includes now October data. So we're usually around halfway on the down leg. So the down leg will probably finish right around here. I hear a lot of concerns about affordability, and you may have heard it in the news. And so I think it's important to have the context, because not all markets perform the same, and affordability is vastly different in the US. If you travel a little bit, then you see this. Let me show you a few things here. I have here the Austin market in that dark purple color here. And Austin was an absolute poster child of a high-flying market in 2021 and in 2022. You can see here it totally outperformed the national market, absolutely beat the national average. Home prices absolutely exploded. The rental market, by the way, the same thing in Austin. And then, of course, when the party was over, things started settling down, and we're now back. It actually fell a little bit below the national average. So if you look today at the Austin market, they have 5-6 months worth of inventory. It takes a long time to sell a house there, so that makes it interesting. I have a client right now that's moving from Austin to Milwaukee, so we have to coordinate that a little bit. And, they're fortunately in a better situation because they bought their home there a long time ago. But if you bought it here at the peak and then you're here, that's not fun. But not every market corrected like this, I should say. Here I have Seattle, and you can see we have seen the same running hot here in the COVID years, but it recovered a little bit and it's still going up here. So Seattle, a lot more expensive than all these other markets, and it did not correct all the way down to the national average. It just keeps on going. By the way, I also have Florida here in gray, Jacksonville. It's general the southern markets that we see at the moment correcting a little bit from the highs during COVID. And if you think that Seattle is a really expensive market, let me throw up one more here. This is San Jose in California, Silicon Valley. Absolutely insane real estate prices. This makes no sense. So what I'm telling you here is, when you think that affordability in Milwaukee is bad, I will agree with you. It has not gotten better. It has gotten worse. But there are a lot of places in the country where the affordability question is magnitudes different than it is here in Milwaukee. Let's take a look at the economy. Here I have the latest data from the job market, and I'll walk you through that chart here. So to summarize this, the job market remains strong at the moment, but it is cooling, which, by the way, is something that we want because it was way overheated in the last couple of years. So when you look at this chart, over the last 25 years, so historically, we always had a lot more people looking for jobs. So the red line here is people that were looking for jobs. Here's the 2008 recession, and a lot of people were looking for jobs, and the blue line is how many jobs were offered. And then COVID happens, and the two lines flip-flopped. So we ended up in that insane situation where we had a lot more job openings than we had people that were looking for jobs. And this is now coming to normalize, I would say, here. And these two lines are probably crossing maybe 2025, who knows? But that's what the chart is looking here. So high level, the job market is remaining strong, but it is cooling overall. In my book, from my perspective, that is good news. I don't expect any major implications for the real estate market from that. Of course, if people are losing their jobs, or if they have the fear that they're losing their jobs, or their hours are going to get cut, so they're making less next month, then they will not buy a new house, of course. But if the job market looks stable and normalizes, then that sets them up completely differently. In terms of unemployment rate, we are at 4.2% nationally, and I have to say it always prides me to look up the latest number for Wisconsin, 2.9%. So we're doing quite a bit better than the national average here in Wisconsin. And payroll numbers increased by 227,000. You've probably seen this in the news in November, so that further underlines this. So not much change here from the job market. What's going on with the Fed? We have the next meeting on the 18th of December, and the market is expecting that Jerome and his team are going to lower the federal funds rate by 0.25%. As you know, federal funds rate is not the same as a mortgage rate. They are somewhat related, but I've talked about this a lot. They're not the same. Go back and watch some of my videos on the topic here if you're interested. The chart that I have here kind of shows you big picture what happened here. So we have here inflation going up. The green line is consumer price index, CPI. That's what most people are looking for. There's different metrics you can look at, and then people are arguing over how high is inflation. That's part of the answer here. So it depends on which metric you're looking at, but all of them have spiked here in 2022, and that is also when the Fed started to jack up interest rates. Remember back here, they were just saying, oh, it's only transitionary, it's only temporary, don't worry about it, it'll be fine. And then here they started panicking, and they started jacking up the funds rate at a pace and speed and rate that has never been done before. So historically, they've been always more careful. So they went up like this. And that got actually a lot of banks in trouble because the changes came so fast that the banks couldn't readjust their portfolios. And we've seen a few banks go out of business. Maybe you remember Silicon Valley Bank. That happened back here. Then, for the longest time, they've held the funds rate steady. And now we have seen two cutbacks already, and we are expecting another one in December. Just a little one, only 0.25%. But Jerome Powell is also saying that we are in a good position, so we may not have to cut rates that much going into next year. So this summer he was kind of indicating there are going to be a lot of rate cuts, and now he's a little bit more careful and more guarded with that. And there might be a few, but not that many. Depending on how the market is developing and going here. So what does that mean for mortgage rates? Mortgage rates are not set by the Fed. They are set by the bond market. So if you want to see what's going on with mortgage rates, watch the 10-year Treasury bond. Then you get an idea. So we are currently in the mid-sixes. This is the latest survey from Freddie Mac, 6.69% on the 30-year. And then in green, you got the 15-year below here. I got a little bit worried here when we were running up here so quickly for a couple weeks, but it looks like we're kind of over the hump now. And the last few days, we have seen every day rates coming down. The lowest rate I've seen in Milwaukee yesterday was 6.125 on a 30-year fixed. So if you have absolutely perfect credit and 20% down and a low DTI, then this is what you get. If your credit is not exactly absolutely stellar, then you might get 6.25 or something along those lines. So it always depends on also how much money you borrow, right? And how much down payment. So there's a lot that goes into this. What can we expect for 2025? So I always follow these guys here, Fannie Mae, the Mortgage Banking Association, and Wells Fargo in terms of what they're predicting here for 2025. This is the spring market here, right around the same. So about 6.5 more or less. The interesting thing is that these expectations have been corrected. Last month, they were more optimistic that rates would be lower in spring. Now they're more careful and more guarded, and they're thinking, let's adjust this up a little bit. So they're kind of thinking 6.5. What does that mean for you? Probably not much. This is not moving the needle one way or another in the mortgage rate environment. And that's how the market is going to look at this. It's kind of things are expected to stay more or less flat. So with that, what are some of the high-level expectations that I have going into next year? Of course, it is the future, and I don't know, but the real estate market is also, kind of slow moving. So you have leading indicators you can look at. It's not like the stock market that can literally turn in a day. real estate is kind of slow moving. It's driven by supply and demand. So we have a little bit of a better angle to forecast things. So I think, and this is also based not on only my opinion, I subscribe to a lot of professional research and, consolidate this here for you every month. So overall, the market is expecting that in 2025, we are going to see more people moving. We have seen sellers holding back with moving. They were handcuffed with like golden handcuffs to their 2.5% mortgage rate and didn't want to, part from that and trade it for a 7% mortgage rate. So we have seen a lot of people that would like to sell their house, not sell their house because they didn't want to give up on their mortgage rate. And we have seen this summer more and more people, just basically, giving up on that and just saying, okay, we've waited long enough, let's just get going. And the expectation is we're going to see more listings. So that means overall an increasing marketplace next year. But also keep in mind that right around 78% of all sellers are also going to be buyers. So from an inventory point of view, you can't expect a whole lot of inventory coming on the market because every seller also needs a place to stay and most of them are not going to rent, they're going to buy another house. And that's the 78%. But overall, more choices, more volume. The Milwaukee housing shortage remains. This is something that you cannot change. It depends on demographics, how many people you have living here, and how many roofs do you have in a metro area. And that ratio has just over the last 20 years gotten worse and worse and worse. And you cannot change that quickly. That also impacts the rental market. So when you look at statistics, I've made a separate video on this. When you look at statistics on what's happening in the rental market, Milwaukee is one of the most competitive markets in the entire US. We are more competitive, for example, than New York because we don't have enough supply and we're not building a whole lot. Millennials will continue to push for their first home. Millennials have been the biggest chunk of home buyers in the last few years. And a lot of them still have not bought a home because they're waiting for better interest rates. They're waiting for a price correction maybe, but they haven't changed their mind. They want to buy a home eventually. They have kids. They got married. They're in their 40s now. And if they haven't bought a home, they want to. So they will keep pushing next year. And we will every year see a certain percentage of them actually succeeding with the goal and buying their first home. New construction starts are probably slower next year for Milwaukee. So I don't have hard data on this, so take it with a grain of salt. This is only anecdotally what I know from speaking with builders. They don't have a lot of land in their back pocket that they bought this year that they're currently subdividing and offering next year. In fact, 2 builders told me that they never had as little in the pipeline as they have now. And we didn't have a whole lot of new construction going on in the first place. And you know this from driving around. Within Milwaukee County, there's hardly any new construction. There's an infill lot here and there, but there's no new subdivisions. So you really have to go out into Ozaki, into Washington, Waukesha County. That's where the new development is. But it's really only a drop in the bucket in terms of what we're seeing. And it's also the wrong price range. So we're seeing new construction home prices going up about $40,000, $50,000 every year over the last years. And, this year it was kind of entry level at $550,000. So I would not be surprised if the entry level is moving up to more like high 500s next year. And that is not where the majority of the market is. And that's not where the majority of the first-time homebuyers are. They are more in the 300 to 400 range, maybe going up to 500, but definitely not over 500. That would be the exception. So the inventory that we additionally creating for the Milwaukee marketplace is the wrong kind of inventory. It's not enough and it doesn't really help. The real estate market, I think, will continue to normalize, but remain competitive. So what do I mean by normalizing? That means we will hopefully go away from the crazy 5 days on market and see listings a little bit longer so you can catch your breath before you have to make an offer, have to make a decision on what you're buying. We have seen it also in the sale to list ratio that the last few years we have been at 103.5%. Some markets were even higher in the 105s. And this year, I think the top was a little over 102. So when you look at the big trend, this is coming down a little bit. It starts to normalize, moving in the right direction, but make no mistake, still very, very competitive for next year. Milwaukee home prices will step up. I think you've seen this on the chart with the annual, price curve. There is nothing on the radar that is telling me that 2025 would look any different than 2024 and the years prior. So bar of anything really majorly happening that's totally unexpected, that's kind of what we will have to see. What do we have to watch for? Inventory is the most important thing, because inventory kind of tells you the state of the market. If you get a lot more inventory, it kind of makes it easier for buyers. Days on market become longer. Sellers become more willing to negotiate the price a little bit. So that's the inventory is always the early indicator of a price change. And we're not talking early indicator of a few weeks. We're talking months and years. Early indicator when you see inventory changing. Interest rates have a huge impact on the market. So I've spoken a lot about this in the past. If we would see rates going below 6, so even 5.99, that would bring a lot of buyers back into the market that have kind of stepped on the sidelines. Some statistics talk about 70% who have given up because of interest rates. So at the moment, the outlook is rather careful, but interest rates will have a big impact on that. And also the labor market for the reasons discussed earlier. So definitely what we want to watch are new economic policies. We have a new administration in Washington. There is no telling for me what is actually going to happen. So we will have to watch the first 100 days. And then, of course, the impact on real estate is not going to be immediate. So the soonest I can see the new administration impacting the real estate market one way or another, I have no idea, is going to be the second half of next year. And before I let you go, I have one more very important thing for you. On behalf of the entire On Point team, I would like to thank you for a fantastic year. It has been our pleasure and our privilege to help you with your real estate transaction. Thank you very much for trusting us with that. This is the team that brought 105 transactions across the finish line. All of them are rock stars in their own rights, and I'm super proud of everybody. Without Casey, Spencer, Ben, and Shannon, it would not have been possible. And not in the picture, by the way, here are the team babies. I think we're up to 6 team babies now. So we just had an addition. I'm not going to single anybody out here. But we're ready for you to whatever you need in 2025. If you've done a transaction with us in the past and you have a real estate question, and even if it's just a construction question and you want us to help you with making a decision on what kind of LVP flooring is the best for your house, we are always just a text message away. Happy to help you connect with your friends and family if they can need our help. And with that, we all wish you a happy new year, happy holidays, and we'll see you in 2025.